is DDS, Dillard's. So I'm expecting the stock to break down through this massive support that is hanging on for a long, long time. So DDS, Dillard's, is an apparel slash all kinds of things, you know, departmental stores. You can see them in the mall all the time. I'm sure many of you have shopped them. If I go to the weekly chart, so first on the technical side, it came down hard in 2015, and then it started to form this large base. And it kept retesting this level. Let's call it $54 to $56 level. This is the weekly chart. It's testing this and testing this, testing this, testing again. And so I think it's about time for this to crack through this and head south. Maybe as low as below 50, maybe even $40 a level. Let's go even longer term weekly chart so you can see what I'm talking about. So here's this big giant, you know, base formation that has been taking place for a whole year. I think it's going to crack through this, and I think it's going to go down. All right, and the earnings are coming out next week on Tuesday after market close. So we'll get another shot to discuss this. We'll get another chance to discuss this in detail in webinar next week. By the way, I just wanted to mention one thing real quick. Next week, we're going to do, again, 2 webinars next week as well on Tuesdays and Thursdays. But after next week, we're going to reverse. We're going to go back to doing only 1 per week, starting from the following week. Okay, so next week we're still going to do, but after that, we're just going to do 1 per week. Anyway, so I'm looking for a breakdown through $54 per share in the stock. Now, so the technicals look, neutral, in my opinion. They're not entirely bearish. Because this is a big formation, big base formation right over here in mid-50s. So it's not technically so far breaking down through that. But when I'm going to walk you through this chart, I think you'll start to see a picture of why I'm bearish in this particular one. All right. On the option side, real quick, just to mention, there is a little bit of put buying taking place, but not significantly. You know, there was a in the last couple of days, I've seen basically just a little bit put buying in this in the May 55 strike puts, where the open interest has gradually increased to 3,300. It's not much, to be honest, but this doesn't really see a lot of put activity anyway. Let me just check something here real quick. Yeah, there's not much activity in this that we see usually in this, but so, you know, just keep that in mind. Now on the fundamental side of things, let me pull my folder just a second. Okay, so right here, the company posted earnings, the Q3 earnings, and the stock ripped higher on heavy volume. But keep in mind that it wasn't just DDS at the time. If you look at it, it was Kohl's at the same time, November 8th. It was Macy's at the same time, big time, November 9th. It was JCPenney even, same time. You know, it was Nordstrom at the same time, right? So they all ripped higher on November 8th, November 9th. What was simultaneously what happened? Well, it was elections. Remember, elections, immediately after election, consumer discretionary stocks took off big time. So it wasn't so much of a characterization of what the earnings were like at the time, but it was actually what the sentiment was shifting about consumer discretionary spending, you know, immediately after election. That's why the whole group ran higher. And if you guys remember, as it was running higher, I even presented a bearish case on Kohl's when it was at the highs at the time. But anyways, the stock came right back down. The earnings were pathetic. Okay, the earnings were not very, very good, actually, and I'll get to that in just a moment. But as the stock kept starting to come back down, you'll notice that there was this big high volume. Look at the big volume right here. Suddenly there was a big high spike volume sell-off into this, and the stock got smacked down to the $55 level. It actually broke down, but only briefly. And since then, in my opinion, it has been forming what I call basically a bear flag. What happened right here in January, as well as right here? There was a big spike down right here. There was a big spike down right here. This was also high volume. This was also high volume, and this was high volume. So what happened right here in late December for 2 to 3 weeks in a row? I'm going to show you something. And here is a comment from Bank of America from December 9th. Okay, and this was on December 9th. So remember, the earnings came out right here in November 9th. Okay, so this comment came on December 9th, and this was after the channel checks and everything. And it says, traffic weakness persists through third quarter. Don't get confused about the quarters. Transaction, basically it's talking about the forward looking after the earnings had already come out. Transactions, a proxy for traffic, fell 6% in third quarter, in line with the first half. On a two-year basis, transactions dropped 13% in third quarter, which was much worse than 11% drop in the first half. Average dollars per transaction at Dillard's rose 1%, in third quarter, also worse than the 2% increase in the first half. And then it goes on to say we are modeling a 3% decline in the fourth quarter comps. So this is the same store sales we're talking about over here. That note came out on December 9th, and it was done based on channel checks. And right here, it was right here, the stock was, and since then it basically kept selling off and off. On January 5th, there was ICFR conference that Jay had talked about multiple times. He mentioned this in the chat room and other places. And DDS provided absolutely hideous guidance. So this high volume sell-off was a confirmation of what Bank of America was already pointing out right over here. And the company basically came out of the conference and said that, hey, we're not having a good quarter. And the stock sold off big time. Now, here's something funny. DDS and Nordstrom, which was my second bearish trade that I brought today, DDS and Nordstrom, JWN, are the only two departmental stores that do not pre-announce earnings, which is precisely why I think the risk of them falling below the street expectations is higher than other departmental stores, and why I'm picking to choose these two. I'm picking these two to basically short going into earnings versus others. DDS has not provided the pre-announcement for its Q4 earnings. So the models have not been adjusted yet. The street models have not been adjusted yet, but everybody else has provided. Nordstrom was the only second departmental store to not provide a pre-announcement for Q4. So again, the same case over there. The models have not been adjusted on the street. And this data from here, from December, as well as what the management said at the ICFR conference, basically confirms the trend. Now, let's fast forward further right over here, come to the current side, and this data came from Bank of America very recently. This was from February 16th. Okay, so this is today, actually. And it basically further highlights the same thing that we have been seeing. This applies not only to those departmental stores, but to everybody. So they're saying that the data for fourth quarter 2016 was down 6.3%. This is, by the way, just to kind of quickly tell you real quick, Bank of America credit and debit card division is the biggest in the country, because Bank of America has almost 10%, cash deposits of American consumers and businesses, cash and the checking and savings account deposits, almost 10% of the entire country, which is a statutory limit, the constitutional limit, or what you call it. They cannot be bigger than this. But anyways, that's why it's the biggest bank. So Bank of America puts out their credit and debit card spending data almost on a weekly basis, and it is a very good. It gives you a very good view on how the consumers are spending, generally speaking, on the economy. And so they have details that not a lot of banks have. That's why I love reading all of this detail from them. And it goes to show, this was this week, data for fourth quarter 2016 was down 6.3% on a sales-weighted basis, demonstrating only modest improvement from the third quarters of minus 7.1%. So basically, they're saying that this was no different than how bad it was in the third quarter. And it was worse than the first half of 4.8% drop. So the second half of 2016 was worse than the first half. And it goes to show, this is forward-looking, January was the weakest month of the quarter, down 12% compared to 5.7% decline in December and 3.8% decline in November. A chart to go along with this is right here. And it basically confirms the same thing. So this is the BSE, Bank of America aggregated credit and debit card spending, implies only very modest sequential improvement into 4Q from 3Q. So they're talking about it because this is a modest improvement. But look at how disaster this thing is. I mean, this is just, you know, I mean, these are very big negative trends for departmental card spending. I mean, this is the 3-year monthly, this is year-over-year 3-month average, these yellow bars, departmental store card spending, and this is the comp store sales growth. So these are pretty negative numbers from Bank of America. So I'll forward the file in just a moment. I'll share that with everybody. So I'm expecting, based on the data, based on what we saw in the foot traffic, remember this, the transaction, which is a proxy for traffic, fell 6%. So, and this all came out around here. I think the stock is sitting in a bear flag formation right near 52-week low, and I think we're going to see an absolutely disaster quarter, more than 3% same-store sales decline, and I think the stock is going to go straight down, and it's going to break down from this $54 support level. So, what's the trade over here? All right. Well, the trade over here is pretty simple. And we're talking about earnings that's going to be out after February expiration, right? So tomorrow is February expiration. Well, I don't want to make this any more complicated. I'm going to keep it extremely simple. Go to March and buy straight March 57.5 puts they're going for 225 to 245. All right, buy straight March 57.5 puts, you can afford $2.40 or less. So just slightly below the offer. We're going for 225 to 245. I think you can buy it for $2.40 or less. And the straight March 57.5 strike puts. All right. And basically, you're looking for a crash, and you're looking for the stock to go below $54 level, right below this level. Okay, so that's what you're looking for. And you know what? I'll be honest.